Bank of England has kept interest rates steady at 5.25%, with authorities optimistic that inflation is heading down. Some analysts are forecasting rate cuts as early as June, but in the US, the Fed is less optimistic about the progress of reducing inflation. So what are the drivers of inflation for these economies and how do they differ? In the UK, inflation has been on the rise, propelled by soaring food and energy bills. Demand for oil and gas has skyrocketed after the COVID-19 pandemic, with global events like Russia's war in Ukraine and Israel's onslaught in Gaza pushing prices up further. But food price inflation has been falling in the UK to 3.9% in March. That's down from 5% in February and well below the 19.6% that was a year earlier. This is due to reduced wheat and feed prices, which have recovered following the war in Ukraine. In the US, the main drivers of inflation are sustained wage growth and sheltering costs, which includes rents, and these have continued to rise. Analysts also say that high corporate profits by keeping prices high despite falling cost is another indicator keeping inflation up in the US. For more on this now, we are joined by Josh Mahoney, who is a Scope Markets Chief Market Analyst, and he joins us now live from London. Josh, great to have you with us on the programme. So that's a good one. What are the main differences, do you think, between UK and US inflation? Can you help us understand which is more supply-driven and which is more demand-driven, as they say, and what does this mean?
Yeah, I would say one of the key similarities between the two is the heavy weighting of the housing sector. Of course, anyone that has a mortgage or even has to pay rent will obviously understand that that can be a huge chunk of your money each month, and therefore that is a justified weighting. But that is just something that has really been something that analysts have had to pick through because it's very slow moving, and we have been seeing it drift lower. But notably over in the US, 40% of the US do not have a mortgage in terms of homeowners. So they've been less responsive to increased interest rates. In terms of elsewhere in the economy, what we have been seeing more recently is movement within the energy prices, and that really feeds into different aspects of it. Of course, it provides underlying inflation pressures for businesses, and like you alluded to, wages are also key within that. Both the US and the UK struggling to drive down wages. At the moment, we saw that this morning with a 5.7 average earnings figure from the UK. What we've been seeing more recently in terms of the US economy is certain factors such as transportation and apparel really being a problem in terms of driving it lower. And really that does highlight the strength within the US consumer at the moment. And of course, that is more on the sort of demand side of things. In terms of the UK, we've got recreation and culture, food prices and restaurants and hotels all slowing down recently. And this highlights the difference in terms of the growth trajectory. We have seen a better than expected UK GDP number, but still that sort of slower growth trajectory in the UK has been beneficial in terms of driving down inflation.
That was a very comprehensive analysis on prices. That's great. Josh, some analysts are now projecting, and they now think that inflation in the UK will fall below the BOE's target of 2%. Not all, but some. Do you agree? And in that case, what do you think the Bank of England will do?
Well, this is a particularly interesting one, and in actual fact, it comes down to base effects, which means that if you form a 12-month inflation view, that's made up of 12 separate months. So you can look at the breakdown of monthly inflation and see where those big prints are from last year that are going to drop out. Notably, this coming inflation report has a 1.2% inflation dropping out, and the next one is 0.6. So within two inflation reports, you've got 1.8% worth of inflation dropping out. UK inflation currently 3.2%. So if UK inflation can come in relatively low for those 2 months, and bear in mind energy prices have come down over that period, then that could drive us back down towards target, and that points towards the possibility of a June rate cut. Markets currently pricing it at 50%, so essentially a coin toss as things stand.
Interesting. Josh Mahoney, thank you for being with us today.